Welcome to Fred's Financial Planning Workshops. Today we're going to be covering a review of the material presented at our previous workshops. I'm Fred Smith with the Silicon Valley chapter of the AAII, and I've given you our local chapter website here where the slides and the video recordings for these workshops are available. I've also given you my email address so that you can send me any questions you may have or comments. We start off with our standard disclaimer, which in essence says that this material is being presented for educational purposes only, and the opinions expressed are mine and not necessarily those of the AAII. Nothing should be construed as a solicitation or offer to buy or sell any material. And I also want to comment here that a lot of the topics we're discussing in these workshops can be complicated, so please see a qualified professional before you make any major decisions. Okay, so the financial planning workshops, we've been running these for the past year almost. We started off with a couple of workshops in investing, and then covered taxes. We had 2 workshops in retirement planning, then moved into insurance, and we had broke out separate sessions from the insurance to cover Social Security and Medicare, and the previous workshop covered estate planning, and then finally with this one we're going to do a wrap-up of the previous material. All of these workshops are available from both the slides and the recordings on our local chapter website. So today we're going to cover very quickly life planning. The view from 30,000 feet, the big picture. Then we're going to get into a little more detail, looking at the 5 pillars of financial planning: for investing, taxes, retirement planning, risk management or insurance, and estate planning. And then we'll wrap up with a quick look at a retirement income literacy survey and the results of that survey. And it also includes a quiz that you may be interested in taking. So life planning, the whole goal here is to align your dollars with your values. You first want to define the life that you want to live, and it's difficult to make a plan until you've got that defined. I think Yogi Berra said it best: if we don't know where we're going, we may end up someplace else. You should recognize that money is just a means to an end here. It's not the goal in itself, and some of the big questions don't involve dollar signs at all. As an aid to getting started on this, you may want to pull up George Kinder's big questions and sit down in a nice quiet room somewhere to note down your answers to them. He starts off asking, how would you live your life if you had plenty of money? If money was no object, what would you do differently? Would you continue to do what you're doing, or are there changes you would want to make? What if you went to your doctor for your annual physical and he told you the unfortunate news that you only 5 years left to live? What would you change? In your last 5 years, what would be important for you to do? And the final question relates to a more serious diagnosis. He basically tells you time's up. So what would you most regret not having done, not being able to get to? These may sound like very simple questions, but the answers are actually pretty deep. And I suggest that you give them some serious thought, and also to write down your answers so you have them for future reference. Okay, we start off with investing. Here we're showing the 5-step process. We start off with the Know Thyself Personal Investor Profile, the PIP. And that's just basically a definition of who you are, your age, your marital status, what your time horizon is, and your risk tolerance, and all that good stuff. And we followed that up with probably one of the most important documents you can write, certainly with regard to investing, and that is your investment policy statement, your IPS. That should include your overall philosophy on what you're trying to accomplish with your investment, what your goals are, what asset classes you hope to use, which ones you don't want to use. It should include, the asset allocation that you think that you figured out is appropriate to the risk tolerance that you defined in your PIP. It should include what rules that you want to lay down for yourself for making purchases and for sales. So it's a fairly complete document, but both of these together don't have to be more than maybe one page, but you really should write them down. Main purpose in doing that is that if you think them through carefully, when things are dull and boring on the investment world, it means that when that world changes and something drastic is going on, with the stock market, instead of making knee-jerk reactions to what's happening, you can refer back to your IPS and figure out from that very simply what you had planned in a nice quiet moment that you should be doing under these circumstances. So when you get these two documents worked through, next stage is to do the detailed design on your portfolio, following the rules that you've set out previously. That involves picking the specific securities for each of your accounts and sorting out which accounts you have for taxable or retirement accounts and so on. Each of those you're going to have to pick the specific securities that you want and the number of shares in each. And the fourth step is obviously it's nice simple go do it. Go online and actually make the trades to get your portfolio into the condition that you've defined in the third step. If you already have a sizable portfolio that's scattered all over the place, you may want to do this on a more gradual basis than just do it all at once. Then the final step is to monitor your portfolio on a regular basis. Regular is the definition of regular kind of depends on whether you're doing active strategy or passive one and so on. If you're following a passive strategy, it may be that monitoring it on an annual basis is adequate. But on the other hand, if you've defined an active strategy to follow, then you're obviously going to look at it more often, on a monthly basis or even weekly or daily. I'm showing here just a somewhat subjective look at what I consider the universe that's available to investors. And we start off with a timeline at the bottom, which goes from years through months and weeks down to days, for the day traders. But on the left-hand end of it, where you're talking about a long time horizon, if that's what you're called out in your IPS and your PIP, then you may want to consider a buy and rebalance portfolio, just building a diversified portfolio and looking at it, retweaking and rebalancing it on an annual basis. For folks that are looking to be a little more active, there are contrarian strategies that involve value funds, and you may be involved with investing, putting the investing of dividends as one of your primary goals, that sort of stuff. Momentum strategies usually have a shorter time horizon, and you're going to be actively involved in stock picking and market timing. And then finally, up in the top corner on the very rapid time horizon, you have what I really consider speculation, doing day trading. Some folks do that on a regular basis and swear that they can come out ahead. I think the data that I've seen shows that may be questionable. Okay, I want to look very quickly at the differences between the active and passive strategies. First of all, I've defined a passive investor as somebody who builds a diversified portfolio of cheap index funds. And by definition, the passive investor is going to get the market return less a small expense, because most of the index funds have expense ratios in the region of a 0.1% or less. Some of them will be a little higher, for the internationals and so on. But all of the passive investors are presumably aiming for the same target, on the dartboard, which will be the for any given market, you're shooting to get the market, the market return. So since everybody's aiming for that same market, the distribution should be fairly tight. An active investor I've defined simply as anybody who's not a passive investor. So that means right up front that the sum of the active investors plus the passive investors is the total market. And because of that, the active investor on average also must get the market return less an expense. And that expense is usually a little bit higher for the active investors because they are looking for more esoteric funds, as it were, or stocks. And there'll usually be more frequent trading, and there may be a wider bid-ask spread. So typically, the active investor will have a larger expense ratio than the passive investor, and also they're aiming for totally different parts of the market. So you usually get a wide distribution for amongst the active investors. Some may do very well and make the right decisions in a given time frame. Others will be at the other extreme, and you'll get a wide spread. What I'm showing here is what the spread looks like for both the active and the passive distributions. The green line in the middle represents the passive investor distribution, around a nominal market return of 10%. I've somewhat arbitrarily picked the 10% even just to simplify everything, but it's not a bad representation of what the total return would be for the total stock market on a long-term basis. The passive distribution isn't quite at the 10%. It's adjusted slightly to the left, maybe 1/10% or 0.2% to the left to allow for the expenses. The red line represents the active distribution, and obviously it's much wider. It's again centered around the 10% market return, except that it's offset a little bit to the left to indicate the higher expenses. This could be anywhere, from 0.5% through 1 or even 2%, for anybody that's, investing in hedge funds or something like that. Now, on the right-hand side of that is obviously, at this point here is where the active investors are shooting for, and they're hoping that, that they have the wisdom and the expertise to pick securities that let them beat the market and come into this area of the distribution. However, for everybody that picks the correct area here, there's somebody who's on the other side of that trade and has made a wrong guess and winds up on the left-hand side of the distribution, which is not good. Pardon me. Overall, since the average for the active distribution is going to be centered a little lower than the passive distributions, typically there will be somewhat larger. The left-hand portion of the distribution is going to be somewhat larger than the right-hand portion because of that offset. So it turns out that the data shows that typically over a long time frame, you get 1/3 of the active investors guessing correctly and 2/3 on the left-hand side. In other words, most of the active investors who are aiming to beat the market on average fail to do so. That doesn't mean that that's not possible to beat the market. And on any given time frame, on any given year, a significant number of the active investors will beat the market. It's just very, very difficult to do it on a regular basis. The probability of doing it on a regular, consistent basis is vanishingly small. So for every trade that you make, here's some things you need to think about. The first issue is who is on the other side of that trade. it's likely to be, some of the big players, the endowment funds, pension funds, mutual funds, all of this. There'll be some individual investors there, and I've broken them into two classes: the smart individual investors and the not so smart. I don't want to call them dumb. Let's just say not so smart. So the big question you should have for yourself is, do you have an unfair advantage against whoever's on the other side of the trade? Do you have better data than he or she does? Do you have more experience? Are you smarter than that other person? What is your unfair advantage to make you think that you can outperform or outguess that other trader? And you really don't want to be making trades against the big guys, against the professionals, because they're likely to more information and better data, better experience than you do. Well, maybe not more experience, but it certainly could be. And you need to think, the ideal person at the other end of the trade that you're making would be one of the not so smart individual investors, and you would hope that you are smarter than he or she is, and for whatever you're buying makes more sense to buy it than the not so smart person on the other side of the trade is in selling it. So the question comes down to, are there enough not so smart individuals to take the other side of your trade and make it worthwhile? One of the comments I've heard on this is, I think sums it all up. How much would you bet on a tennis match if your opponent was a full-time professional? Think about it. So summing up, the takeaway for investing is, I'd say, first of all, keep it simple. My own 10-word summary for my investment policy statement says something like, build a diversified portfolio of cheap index funds and rebalance annually. I'm not saying everybody, first of all, my full IPS is obviously a little bit longer than that. That's just a summary of the philosophy. But it would be very, very helpful, if you try to see if you can summarize your philosophy in 10 words or less. That'd be a challenge that I would give to you, because if you're having difficulty summarizing it, in a few words, it may be too complicated. There's something else I would point you to, and that's the frustrating law of active management. This was developed by Corey Hofstein and some other people at Newfound Research. And he argued that for a strategy to outperform in the long run, it must underline, underperform in the short run to force the weak hands to fold. Because it's forcing the weak hands out of the game that in the short term is what gives you the long-term advantage. So if you're going to go with an active strategy, you've got to be prepared to take a deep breath and live with the short-term underperformance, which can be significant at times, and just have the confidence to ride out your strategy in the long term. Otherwise, you'll turn into one of the short-term guys that gets forced to fold with a losing position. I think Charlie Ellis summed it up well, what I call the quote of the day. If you must play the market to satisfy an emotional niche, recognize that you're gambling on your ability to beat the pros. So limit the amounts you play with to the amounts you would gamble with the pros at Las Vegas. A sobering thought. Okay, now we're going to move on to taxes. The last 2 or 3 years, we've had a fairly active tax environment. At the end of 2017, effective, I guess, mostly starting in 2018, was the TCJA, the Tax Cuts and Jobs Act. And the big item on that was, one of the big items on that was the reduction of the corporate tax rate from 35% to 21% to align it more with what's going on with the rest of the world. On an individual basis, the standard deduction got increased from 12,000 and change up to 24,000. In other words, it got doubled. So that changed the strategy for a lot of folks that are doing their own tax returns. The folks that used to itemize prior to this, we may now find that that with the larger standard deduction, they don't need to itemize anymore. They can do better taking the larger deduction. And that was a big plus for the individual people. On the other hand, they say that the large print giveth and the small print taketh away. The small print in this case is for the state and local taxes got capped at a $10,000 deduction, which may not make a whole lot of may not be too big of a problem in the states with low taxes, but for the states like New York or California, with the high tax rates, that could be a limitation for many people. And the other thing that was included in that act was the increase of the estate tax exclusion. It was roughly a factor of 2 increase as well, up to 11,000 and change, 11 million, I'm sorry, and change per individual. It'd be 22 million, 23 million for a couple. That means that most people probably don't need to worry about the estate taxes when they're doing their estate planning, except this law sunsets at the end of 2025 and reverts back to the original numbers, which I believe were in the $5 million range. So it makes it very difficult to do estate planning. If you get one result, if you pass away between now and December 2025, and if you manage to live into 2026, the law can be different unless Congress gets in there and adjusts it prior to that. The other notable act was the Secure Act at the end of 2019. And the big change there was to move the RMDs, the required minimum distributions, could be initially started at age 70 and a half, but that's been delayed out to age 72, which helps a little bit. You should be aware that the current, I think they're calling it Secure Act 2, that's working its way through Congress currently in some form or other. One of the items in there was to move it out further to age 75, I believe, but that may or may not become law in the future. It's still being negotiated. The other item that was included in the Secure Act was the inherited an IRA. It's no longer possible to do a stretch IRA. That part of it has gone away, except for a few exceptions, mostly for a spouse, but for anybody else. The stretch IRA has disappeared, and you have a maximum of 10 years in which it has to be liquidated. The CARES Act in March of 2020 was mostly set up to give some relief to the pandemic that's been sweeping the country or the world for the past year and a half. Tax diversification is an important concept in my mind. Anybody that's been listening to any of these workshops previously will know that diversification is one of my favorite words. And in the tax world, it applies as well. And it's mostly applicable in terms of what assets you put into which of your 3 different characters of accounts. We've got, most folks have a traditional IRA, and they're aware that the contributions to that are deductible, but that the distributions from that are taxed as ordinary income. And so that's a problem with that. On the other extreme, the Roth IRAs, you're already paying taxes at the income tax level, at your income level for the contributions, but the distributions are not taxed ever. In between, you've got your taxable accounts, where the contributions are again taxed as ordinary income, and the distributions from that may be taxed as ordinary income or capital gains, depending on their character. And if you look at the use of these for an inheritance, For a traditional, well, let's look at the good part first. For the Roth IRA, that's the best inheritance you could imagine because there are no taxes going to be paid on it. So that works well. But for a traditional IRA, it's the worst possible inheritance you could get because every penny that's pulled out by the heirs is going to be taxed as ordinary income. And again, the taxable account kind of fits in the middle of these two. It's actually closer to the Roth because with the taxable account, the heirs get a step up in the cost basis for the portfolio that they inherit. The cost basis gets stepped up to the value on the day of death. So the only taxes that will be paid are any gains that accrue after the day of death. You should be aware, however, that this also is being considered in Congress, that may be eliminated. But if it were eliminated, we don't know yet. It could change how you allocate assets to your taxable account. If it is eliminated, it's not just a financial penalty that you'd be paying, that you'd have to basically take the previous, cost basis of the deceased person when the securities were initially purchased, but you have the hassle of going back and digging out that cost basis over what could be years or even decades and trying to figure what the value of it was. If you can't document the cost basis, the IRS has an initial starting point of saying, okay, we're going to assume it's zero. So that would be a penalty. I think you can probably negotiate your way above a zero, but it could be quite a lot of work to dig out what the cost basis is. So what I've shown with my little stars down here at the bottom is a suggestion of where you may want to locate the individual types of accounts. When you have tax inefficient assets, typically interest-bearing stuff and some of the bond funds and so on that you are paying taxes on at the ordinary income level, those may as well go into your traditional IRA, which is going to be taxed as ordinary income anyway. So there's no additional penalty to putting them in there. On the other side, if you have tax efficient assets, those you should load up initially into your taxable account because you want to minimize the taxes that you're going to be paying year after year after year. So the efficient assets, in other words, the ones that are primarily long-term capital gains and stuff like that, can go into your taxable account. And the rest of the items, which are, well, there are 2 or 3 different types of items that belong in your Roth. First of all, REITs and stuff like that get taxed fairly heavily, so you may as well put those in your Roth where they won't be taxed. And also some of the high growth, high volatility investments may as well go into your Roth because then hopefully that will be invested on a long-term basis to minimize the volatility, and the higher capital gains that you get there will not be taxed in the Roth. These are meant as suggestions of where to start. Now, obviously, you're not going to have the 3 characteristic accounts broken out equally, or to match the assets in your portfolio. But the ones with the most stars are where I would suggest you start loading those assets into those accounts, and the least stars should only be after you've done everything else that you can. I wanted to cover some tax saving strategies that are available. Just looking real briefly, the very first one is what we've just talked about: tax diversification and putting the correct assets into the correct accounts. Next one is one that's kind of triggered by the recent tax law changes. Since the standard deduction has increased, it's less useful for a lot of people to take itemized deductions, which kind of limits the benefits of charitable contributions. But if you're on the edge, on the margin, it may make sense to lump your charitable contributions into one year in which case you itemize your deductions for that year and then use the standard deduction for the other years. And the easiest way to do this is to use a donor advised fund where you can make a contribution, in 1 year, perhaps a large contribution to cover 3, 4, 5 years of donations, and the deduction, is totally all of it available in the current year that you make the deduction and can be included in your itemized deductions. But then you can spread the grants to the various charities over whatever time frame you want. They do not have to be linked in time to the initial donation. So it's a way of bunching your contributions into one, in your deductible contribution into 1 year, but spreading out the actual grants over whatever time frame suits you better. The other asset strategy, or the other taxing strategy that you may want to look at, is being careful about your tax bracket, keeping an eye on it. If you're in a low bracket for any reason, it may make sense to fill up that bracket, to the top of that bracket with capital gains or Roth conversion or something to capitalize on the low tax bracket that you are in currently, and avoid the higher taxes later on. And one way in which you might find yourself in the low tax bracket would be after retirement, when you no longer have a regular paycheck, salary check coming in every week or every month, but before your RMD start at age 72. So there may be a window in there where you're in a lower tax bracket, and you should probably consider making some trades on your portfolio that you might otherwise want to delay. It may be worthwhile bringing them forward. Tax loss harvesting is a little controversial in my mind. The concept is to sell some of your losses this year to bring down to use against the capital gains that you're reporting, and then reduce your taxes a little bit, and then you can buy back a similar asset, to replace the one that you've sold, but you'll have a higher cost basis, obviously, for that. So what you're really doing is saving taxes a little bit this year in order to, so you'll be paying higher taxes potentially later. And you have to watch out for the wash sale rules, and that you can't buy back the exact same asset within 30 days, either before or after the loss sale. But you can buy something similar in that time frame, or if you wait until 31 days afterwards, then you can actually buy back the same security. I think this is most useful for stuff that you're really planning on a long-term basis, and especially for legacies, because in that case, the penalty of having to pay higher taxes because of the higher cost basis that you've replaced goes away. If you're, for the legacy, they won't, if they get the cost basis will be unimportant to them, certainly with the current rules. So you may want to look into tax loss harvesting. The takeaway for taxes is, keep alert. There are opportunities out there that come up, and then the tax laws change from time to time, which provide some of these opportunities, but they're also very unpredictable, and you just got to stay awake to keep up with it. And I'm getting back to diversify for the long haul. And I'm a little skeptical about Congress's ability to reach a consensus on anything, much less what's going to be their strategy over the next year or the next decade or two. Moving on to retirement planning. Retirement planning is all about taking a lumpy cash flow and evening it out. For a typical life cycle, between birth and graduation day, there'd be no income. you won't be earning anything significant, beyond maybe mowing lawns or taking a paper out or something. But all the major income opportunities will be between graduation day and retirement day. So this is when you'll have your maximum input income capacity, and then between your retirement and death, you'll have some income coming from Social Security probably and some other forms, but you'll probably have to reach back into what you accumulated here in order to to fund your expenses through retirement. So you're taking taking a lumpy cash flow and trying to even it out. During the accumulation phase between graduation and retirement, the tools available are the accounts we just talked about, and you probably want to take maximum advantage of the tax-deferred accounts and the tax-free accounts with the various IRAs. For the decumulation phase between retirement and death, when you're pulling money out of your retirement portfolio, it's a little tricky. You have to be careful in figuring how much you pull out and when. And Bengen's 4% rule that most people are at least somewhat familiar with is a good starting point, and there are other variations on that, at a later, the later research. But 4% is a good starting point. Another way of reaching a notion of what's a safe withdrawal rate could be to go to the IRS tables for the required minimum distribution. This is obviously not why the IRS set up the tables, but they've said that from age 70 on, they're telling you what percentage of your retirement plan you must withdraw. They're not saying what you have to spend it on, but if you use those mandatory percentages in the RMD table, they're actually a pretty good starting point for what you might want to withdraw anyway for your expenses in retirement. Bucket strategies are useful here too, and you may want to go back and check some of Christine Ben's papers on bucket strategies. Well, you can go. I've covered some of the details on these in my prior workshop as well. There's a problem that most folks haven't really thought through all that carefully in aligning your assets and your liability, the time frames and the volatility of each of them through retirement. If you look first of all at your assets, most folks will have some Social Security income. They may have a pension or set up an annuity for themselves, but they will have a position where they're getting a regular monthly paycheck, from a reliable source. Next up would be, money market funds and CDs and stuff, that have, they retain their value even with the volatile market. And then as you go up here through long-term bonds and into stocks and stock funds, you get higher returns, but you get higher volatility. And, there are places for these in your portfolio, but you need to make sure that you're treating them in the proper manner. Now, on the other side of the balance sheet, you've got your liabilities during your retirement. It starts off that you need to cover your basic daily needs. How are you going to pay for food and water and shelter and transportation and all of that good stuff? Next up would be a contingency fund, which I guess some folks regard this as an emergency fund. I think of it a little bit differently. The contingency fund, in my mind, is for larger events that really aren't an emergency, because you can plan for them. You may need to buy a new car. You may need to put a new roof on your home, stuff like that. You could be talking about tens of thousands of dollars that put it way beyond your basic needs spending. But you need to cover this. Every few years something's going to be coming up in a higher dollar amount. And next up will be your discretionary goals for vacations and stuff like that. And then at the top of the list will be legacy goals. I think it's important for these two here to have these funded on a safety first basis. In other words, from these type of assets over here, because you have a lifestyle that you need to maintain, and it costs money. It's fairly predictable, and for many people find that that they can sleep a lot better at night if they cover these expenses using fixed income reliable sources over here. For discretionary goals, you may want to maybe more comfortable funding that from the more volatile assets, because if the stock market happens to be down, you might say, well, I'm going to delay that cruise until next year or the year after when things recover. And the same argument can be made on the legacy stuff, that it's not absolutely mandatory, and it will be on a long-term basis anyway. Now, I'm not trying to imply here that you have a one-for-one correlation. I've deliberately offset these. And I'm not saying that that the basic needs have to come from here and the contingency from here, etc. But you should make sure, I think, or I would suggest that you consider using the safety first principle for these guys. That will be at the lower end of your the volatility of your assets, and then only moving up to the higher return, higher risk assets for the negotiable liabilities. This is I call it probability based. That's the term normally used because it's on the probability of how the stock market returns go. On a long-term basis, it does great, but there are down years, and you don't want those down years to change your lifestyle too much. So, takeaway for retirement planning: first and foremost, start saving early. Now, for most folks watching this workshop, they're probably way past the start saving point, but it may well apply to kids or grandkids and so on. The figure that most folks normally use, or certainly the financial planners normally use, would be saving 15% of your salary if you want to maintain the same lifestyle through retirement as you had prior to that. If your saving rate is lower than that, you may well find that that you need to adjust your lifestyle down a little bit because of the size of your portfolio. But 15% is a reasonably safe number for anybody that wants to retire, say in your early to mid 60s or something like that. I suggest setting up a Roth IRA for your kids or grandkids, because the Roth does great for those folks that start really early, and you can accumulate assets in an account where the income from that account grows totally tax-free, and the capital gains in it are totally tax-free, and over many decades that can be a huge benefit, particularly even if it gets passed on to the next generation. As an incentive to your kids or grandkids, well, I'm suggesting that they contribute just about every penny of anything that they earn. They can only contribute earned income into their Roth, or into any IRA for that matter. But if they have a few $100 from paper route or mowing lawns, whatever they do, if you want to have them contribute every penny of that into their account, and as an incentive, you can reimburse them at twice the value just to get their attention. And it's a good way of getting them to start early, to understand how it grows. I said before, the Bengen's 4% rule isn't perfect, but it's a good start. You can push that up to 5 or 6% if you're willing to include some guardrails in there that apply if the market, in a down market, that you may need to cut back, somewhat on what you're pulling out. But if you find yourself coming in with using numbers significantly above the 4 or 5%, you really want to sharpen your pencil and go back and rethink it. Make sure that everything's okay. If everything's not okay, what if you come up short? These are not very popular suggestions, but the levers that you have to pull you don't have all that many of them, and they're not all much fun. Delay retirement is the obvious thing to consider, in that you get a double benefit from it. Number one, you're not pulling assets out. You're delaying when you're pulling assets out of your portfolio, so it's not taking the hit. And then number two, you're paying, making more payments into your portfolio. So if you delay your retirement maybe to age 70 or something like that, the retirement options going forward are significantly improved, more so than you might expect. The other options obviously are save more and spend less, but that's not easy. It's easy to say, but not easy to do. One of the things you may want to consider is an income annuity, because if you're, if you've got a reasonable health record and your parents and grandparents that have a longevity in their genes, the income annuity may work for you if you basically find that you can fund your retirement with your current portfolio out to 80 or 85 or something, but that you're concerned about what might happen, if you live as your grandfather did, perhaps to 95 or 100, then how do you handle that? So an income annuity may be a way of doing that. The insurance company knows, that the actuaries will come up with a number in the mid 80s, and they can play the theory of large numbers game, which you can't do there. So that's an option. You may want to consider a reverse mortgage, which is just a way of pulling the equity out of your home and using that to either generate an annuity, or you can take it out as a lump sum. There are all sorts of rules that go with that, and it only applies if you have significant equity in your home, as in hopefully maybe no mortgage at this time. If you do have a mortgage, it will have to be paid off at that time. So we're going to move on to insurance, risk management. And without saying anything against insurance companies or insurance agents, I want to point out the reality that insurance can be expensive, or is expensive, period. There are three components to the premium that you have to pay. There's the actuarial cost, the risk that the insurance company is covering, but there's also the operational costs. They have to keep the heat and lights on in their building and pay the salaries for their agents and so on, and they're entitled to a reasonable profit. So when you add all of this together, the premium goes up significantly above what you might have to pay yourself if for any items you are in a position to choose to self-insure. And again, like I said, with the theory of large numbers, you can't predict the future, but the insurance folks know, to the day what the lifespan of an average person is. They can calculate that for women, it's a little over age 85, I think, these days, and for men, a tad lower perhaps. So insurance works best for events that have a very low probability of them actually happening. But if it did happen, it would be a life-altering event. The thing that comes to mind here is the insurance that you pay for your homeowners insurance. It would be very unlikely that your home is going to burn to the ground in any given year, but it could happen. And if it did happen, it would put a huge hole in your retirement plan. So it makes sense to insure against something like that. Hopefully you're going to be paying into the insurance company for 30 or 40 years, a premium every year, and never collecting a penny on it. But that's what insurance is all about. So you should insure to manage the risk for the major events, for the life-altering events, and any small events. You should feel comfortable. It would be cheaper to self-insure for items that you can carry yourself. I've listed 5 potential train wrecks here. These are things that would certainly be life-altering if you got caught on the wrong side of them. We start off with disability insurance. This is particularly true, for a young family where the breadwinner is involved in a car accident. If he gets killed in a car accident, that's not the worst thing that could happen. The worst thing that could happen is actually that he'd be seriously disabled, or he or she, I should say, in an accident to the point where they need expensive medical care for the rest of their lives. In the meantime, there's no income coming in from that. So disability or the potential for disability is a major risk that everybody takes, but it's particularly true for younger families, with kids that have, they're hoping not just to support the family, but put the kids through college and all that at a later point. If that's all disappears in a hurry, it's a major blow. The same thing goes for premature death. If the breadwinner, in fact, is killed in a car accident or dies from some other cause, the income stream that the family had planned on bringing in for the rest of his life suddenly has evaporated, and that the purpose of life insurance, particularly term life insurance, is to replace that income stream. If there's no breadwinner around to generate it himself. Longevity is a challenge that a lot of folks don't even think about. The chances are, everybody's living longer these days, and chances are that one or both spouses, for a married couple, could well live, well into their 90s or even beyond 100. And you want to make sure that this is funded, through that age, through the possibility of living to a ripe old age. And if you if your portfolio is not adequate to pull a reasonable withdrawal rate from that through, say, age 100, then you may want to consider an annuity. And you really want to make sure that the portfolio does not run out before you do. Long-term care is another risk that a lot of folks have considered, but have maybe not got all the best information on. People who are looking at long-term care, I think to a great extent, do not realize how major a drain it can be on your portfolio. It can be very, very expensive. The data shows that quite a large number, I can't remember off the top of my head, but something like half the people, turning, in their early 60s are going to need some form of long-term care in the rest of their lives. If it's short-term, short-term meaning, a year or two, they can probably fund that themselves. But then what are the risks? What's the risk of having some form of mental disabilities that mean that you may need help, getting through your day, help with your daily activities, for decades. How is that going to be funded? Final potential train wreck I'm looking at here is the possibility of litigation. What happens if your teenage driver accidentally injures somebody, and your teenager is at fault, and somebody decides to bring suit against you? You can be talking about millions of dollars here very easily, and it could obviously be a major blow to your finances. So I suggest that folks consider an umbrella policy that goes beyond your normal auto policy. Your normal auto policy will have some level of liability coverage in it, but you will probably need coverage way beyond that in this day and age. And umbrella policies are relatively cheap, so it should give you peace of mind. Covering Social Security separately here, it's a form of insurance, but I wanted to hit on it real quickly. Your primary insurance amount it is calculated from your average monthly indexed earnings, your aim. And what happens is the Social Security Administration takes the 35 best years of your earnings, and the early ones are adjusted for inflation, but they take the average of that, and using that you can come up with a primary insurance amount. The primary insurance amount is the amount that you get at your full retirement age, and the full retirement age is defined by the Social Security number, and it varies. It's not the same for everybody, but for folks who were born earlier, the full retirement age would be 65. Folks who were born after roughly, I guess, the mid-50s, 1950s or thereabouts, the full retirement age moves on a little bit later. You can take early benefits as early as age 62, but you pay a significant cost in the benefits that you get at that age, and that penalty stays with you for the rest of your life. It works out as something like a 25% penalty for folks that take their benefits 4 years earlier than the full retirement age. On the other hand, if you elect to delay taking benefits to age 70, you get an 8% per annum increase, and that can be very useful, especially for married couples, married spouses, because the spouse gets the benefit of the higher earnings, if they live for a long time, even if the original earner passes away earlier. Spousal benefit is 50% of the worker's benefit, if they take that full retirement age. And in the case of the death of a spouse, the survivor's benefit is 100% of the worker's benefit, and that's why you want to consider having the higher earning spouse, if at all possible, delay taking benefits to age 70 to maximize the benefits for whichever spouse survives to well into their 90s or longer. Medicare, a lot of people are not very clear on it. There are 4 parts of Medicare, A, B, C, and D, which I've described here or noted here, but you need to be careful that you sign up at the proper time. It's pretty much mandatory that you sign up, with a few exceptions, within the 7-month window around your 65th birthday. There's the 3 months prior to that, then the month of your 65th birthday, and then the 3 months after that. The Part A, is supposedly free, in that you've normally no payment for that because that's already covered by the payments that you've been making all your working life. But there is a charge for Part B, which currently in 2021 is $148.50 per month is the minimum charge. And then for folks in a higher earnings bracket, there's an income-related monthly adjustment amount, an IRMA, that has to be paid. And that's for folks that have a modified adjustment gross income above certain limits from your tax returns 2 years prior to that. Those are the latest returns available to the Social Security Administration. And that IRMA can go as high as an additional $356 and change per month on top of the standard premium. Now that maximum IRMA is only applies to folks with adjusted gross incomes up in the region of I don't remember exactly, $400,000 or $500,000, I believe. Fairly significant income. If you don't sign up for Medicare during the window when you should do, there's a draconian penalty because you're not paying in the premiums that the administration is hoping to get, and there'll be a penalty of 1% per annum. Well, I'm sorry, 1% for each month that you're late, 12% per annum, and that penalty sticks with you for life. So it really is worthwhile making sure that you sign up at the correct time. The only exception I guess would be if you're continuing to work and you can show what they call it, what they define as a creditable plan, a plan that from your employer that is at least as good as that's what you get from Medicare. If that's the case, then you don't have to sign up on your 65th birthday and start paying the Part B premiums. But as soon as you retire from that job, then you better get on board right away, or you will get hit with the penalty. Part D for drugs has the same principle, and you again have to pay an IRMA if your AGI is above the limit. And normally the Part D premium, or the Part D coverage, comes from a private plan that you have to get separately, and it's not included in Medicare proper. You need to recognize that Medicare is limited coverage. There's no coverage at all outside the U.S. So you probably, if you're on Medicare proper, with traditional Medicare, you probably want to consider a Medigap policy to include coverage if you travel abroad. And the other thing that a lot of folks are surprised at, or horribly surprised, is that traditional Medicare has very little coverage for long-term care. The only long-term care that you get is from Medicare is basically rehab for a few months after hospitalization, and you should consider a long-term care policy to cover that, not count on Medicare for it. I'm showing a chart here which compares the traditional Medicare with the Part C Medicare, the Medicare Advantage. And the biggest difference here is that traditional Medicare, the philosophy is a fee-for-service basis, and you can basically go to any doctor who accepts Medicare for your medical needs. The Medicare Advantage plans are run on a different philosophy. It's managed care basis, and you usually have to stay within the network unless it's for emergency, when you happen to be traveling or something. There will be some coverage there. The other differences are listed here, but most of the Medicare Advantage plans do provide coverage, at least some coverage outside the U.S. So for folks who like to travel, this would be one way of getting coverage. If you're on traditional Medicare, you're likely to be carrying three cards in your wallet. The Medicare card, the drug coverage card, and the Medigap card. The last two coming from private insurance companies. Medicare Advantage usually covers all of these, with the one single card. Now, when you turn 65 and you're signing up for Medicare on traditional Medicare, you have to sign up for that initially, but then you can migrate over to the Advantage if you wish to. Going from traditional Medicare to Medicare Advantage is easy, and you can you have an option of changing your plans anytime. There's a 3-month window from, I guess it's October, November, part of December every year to change your plans. And as soon as you sign up for a Medicare Advantage plan, it kind of terminates your traditional Medicare. You should note, though, that going the opposite direction, although it's feasible, and there may be challenges involved in doing it. The problem comes down to insurability. If and when you take your traditional Medicare and sign up for that initially, the Medigap folks have to provide coverage for you if it's at a reasonable cost. The pre-existing conditions and so on will not get in your way. On the other hand, if you're on Medicare, for the Medicare Advantage plan for some time, and then want to go back to this for any reason, the insurance companies it's not mandatory that they insure you at all. They're likely to look at your medical history and determine the premium based on that. And if you have serious pre-existing conditions, they can in fact decide not to insure you at all. So before you make the jump from traditional Medicare to the Medicare Advantage, make sure that that this is something you probably want to stick with permanently. And if you do need to go back, and like I said, it's not impossible, but you may be paying higher rates. Takeaway for insurance is that it can be expensive. It's not an investment. Don't treat it as an investment, and only buy insurance where it's needed. Beware the train wrecks, and Social Security and Medicare, really think about them carefully before you make any decisions on it. Estate planning. Primary documents are the will. Every adult should actually have the first three primary documents: the will, the durable power of attorney, and the healthcare directive. The will is effective on death. So since you can't provide for incapacity in the will, then that's why you need a durable power of attorney for financial or legal affairs, and also the healthcare directive includes the power of attorney for healthcare usually. And every adult, I think, should have those three items covered. For folks that have a more complicated estate, you may want to consider a trust, and there are advantages to the trust in that it's more flexible than a will. It allows you to decide who gets what and how to take care of any individuals that will need care. So you can work out the details a lot more clearly in a trust than you can in the will. It also provides for your own incapacity because it can be effective, become effective before death. So the power of attorney and the healthcare part of it are probably included in the trust. The trust will also include a pour over will to move stuff into the trust that you haven't done explicitly beforehand. And the other advantage of a trust is that it avoids probate. Trusts are more expensive to do than a will. A trust can cost a few $1,000s if you go to a reputable estate planner, whereas wills typically simple wills in the region of a few $100s. Having said that, I'm going to give you a reason now in a minute why trusts can in fact be cheaper for the long haul. And that mostly involves probate. Trust avoids probate, and we all know the cons of probate, the reasons why you don't want to get involved in probate. It's expensive, it's time consuming, and there's a lack of privacy. Anybody can go to the Hall of Records or Town Hall or wherever the data is stored and look it all up. It can take many months, sometimes even years, to work through probate. And when I said it's expensive, it's done on a percentage basis of your gross estate, and the percentage all adds up very, very quickly. You can easily wind up, if for somebody with an estate in the region of, let's say, $1 million or up, you can easily wind up paying tens of thousands of dollars on probate expenses. So it may make the few $1,000s you pay for a trust look cheap in the end. Having said that, all the bad stuff about probate, there are a few pros that go with it. One of them is that anything in probate, as soon as you go to probate, it limits what the creditors' window to make their claims to a 4-month window, and beyond that, the creditors are out of luck. So it lets you wrap up the estate in that regard very quickly. Also, the court supervision can be useful to have somebody look over your shoulder for somebody who's an executor and not quite sure of what they're doing. That help can be useful. If there's any of the property that's transferred, if there happened to be a cloud on the title initially, that gets cleared by probate. And the other thing that I'm not flagged here is that it's useful to have the court to act as umpire, as it were, if there are any disagreements amongst the heirs, or folks are challenging the executor. and the court can step in and act as a referee. So even though I still, for most folks still want to avoid probate, for smaller estates, it may still not be a bad thing. The other thing that you got to be careful with probate is that if you own real estate out of state, vacation homes, rent homes, or whatever in a different state, that's going to trigger probate in that state as well. So that's another thing that can add to the cost and complexity of probate. The practical duties for a trustee, I wanted to go over them in detail, but obviously it's a great honor, to be nominated as a trustee, but recognize that it's time consuming and the hard work. And the other thing is, once you effectively become trustee after the death of the trustor, you can only resign at that point after a replacement trustee has been nominated. You can't leave a vacant spot. Immediate tasks are obviously to take care of all the funeral issues and services, burial, notify Social Security and Medicare. You want to retain an attorney, and you file for new tax ideas, a whole bunch of stuff. Now, if you retain a good attorney, then he or she may help you with a lot of this stuff. But there's a lot to be done, and you need to sort through all of the financial and legal documents and figure which the critical ones are. And you probably need to store those for at least 3 years, maybe longer, 5 to 7 years, before they get destroyed. And the other non-critical ones you should probably shred immediately. For real estate, it's even more complicated. If the home needs to be sold, you obviously need to retain agents to sell the home. But when you reach contract, you may have a little hiccup that occurs there, in that if there are any heirs that are percentage heirs, that that the trust has said that they get 10% of the estate value, or the remainder of the estate value of something else has been allocated, they have a right to know what the 10% of the estate value, what the estate value is. And that means that if you've left an amount to a charitable organization, for example, any of the major ones that would have a legal department, they have to okay the contract before you can close. Everybody with a percentage interest has to okay, and you need to get written approval. But if that includes major charitable organizations with a legal department, maybe back in Chicago or New York or somewhere, it can take weeks to get this written approval. And meantime, you're being forced to delay closing, which will not make you the most popular person in the block. Estate sales, are very time consuming to do yourself. So I'd seriously suggest hiring professionals to do it, even though they will get 40% of the income from it. It's cheap in the end. You may want to do a letter of intent, which is not a legal document, but it provides help to the trustee in working through all the information that he needs on a practical basis to get through that, particularly the first few weeks after he is called for duty. Watch out for your digital world. Your trustee is going to need access to a lot of your accounts, your banks and brokerages, your photo files and all of that. So make sure that they have access to your logon ID and password for all of that. Philanthropy I've included in with the estate planning here because it's somewhat related to that. Besides the responding to the solicitation letters that everybody gets in their mail every week, you may want to consider a donor advised fund for any serious charitable donations you want to make. I think I explained earlier that the donor advised fund, you can take a tax deduction immediately for your contribution to that, but then you can decide later what the grants are going to be made to which organizations and, and when. It gives you the flexibility of allowing you to change your mind and rearrange your charitable distributions at any point, by just going online to the donor advised fund, rather than just going back to the attorney to revise the list if you've included it in the trust. So it simplifies your life a little bit for the trust to just basically say that your donor advised fund will get distributed as they've called out, and then you can make changes easily. There are charitable remainder trust and charitable lead trust behave a little differently, but you need an attorney to set these up, so I'm not going to go into them here. And a private foundation, again, consult an attorney. There are pros and cons, but it gets fairly complicated and there are restrictions, and you absolutely should find a good attorney there. I wanted to put a quick chart up here to show the philanthropic space. This is based kind of on Maslow's hierarchy of needs. You've got basic needs that need to be covered first, that include stuff like safety and shelter and so on, and then going vertically up this scale here. You reach through education and environment and climate control and all of the philanthropic opportunities up there. But these are the upper end. These are sort of hopes and dreams of what might be where you might be able to make some significant changes. On the scale on the bottom is a time scale going from immediate needs out through the long-term needs, with all the intermediate stuff in between. And what I'm saying is, down in this lower corner, where safety and shelter and food and water, are your needs. None of these needs, nothing up here gets satisfied or is important to anybody until everything below it is kind of taken care of. That was Maslow's insight. But basically, you can get bigger bang for the buck by contributing to causes down in the lower left corner here, that might include some of the homeless people, both locally or worldwide. It can include folks that are food challenged and so on. That as you go up further up here, it gets more expensive to help people on a dollars per person basis. There's a figure of merit here called equality, QALI, which is I think it's a quality life adjustment or some such thing, or improvement. It basically puts it puts a dollar number on the improvement that you've been able to create in somebody's life, for a certain length of time. And up here in this end of it, the qualities are pretty expensive, whereas down here you get a much bigger bang for your buck. This is a somewhat subjective chart, and if the concepts are of interest to you here, you probably want to make up your own chart to decide where you want to make your contributions and where they're significant. Okay, the takeaway from estate planning is that, first of all, just do it. I've clearly said here that the perfect is the enemy of the good. The tough part is deciding what you want to do. That's not easy. Once you decide what you want to do, it's relatively straightforward to pick a good attorney and get the plan on record. But do it right now. Don't keep postponing it until you get everything firmed up, because that may never happen. It's relatively straightforward to fine tune the plan at a later point. In fact, you should relook at it, every 3 to 5 years, unless you've got some major life-changing events occurring earlier, which means that you need to look at it then. Most of the tough decisions don't involve the dollar signs, and most of the tough decisions are deciding who gets what and what your overall philosophy is. And I said here, that hiring a good attorney is worth every penny. Don't even think of skimping on it. Okay, the final item on here I wanted to hit very quickly is the Retirement Income Literacy Survey. The American College put out a quiz with 38 questions on it, covering various financial planning topics, similar stuff to what we've been covering in the workshops for the previous months. And the data that they got from this was pretty horrible, astounding. 4 out of 5 older Americans fail to understand basics. 80% of the American population had gaps in their basic investment management style. They didn't know what to do, how to do it, when to do it. Their retirement income literacy was non-existent, and preparedness for long-term care, there's a big gap there. So this survey by the American College is an eye-opener. It was for me anyway, and that's one of the reasons why I'm hoping that the work we've been doing for the past few months has been useful to help folks way out of this thing. I'm hopeful that that the folks who followed me on this journey will be in the top 20%, not fall into the brackets that the American College found. I suggest that you take the quiz, the 38 questions. A very simple quiz, and it covers nice clear-cut topics like we've covered today and previously. And you can go to this website to take the test, or maybe just simpler to Google the 2020 Retirement Income Literacy Survey. You can decide whether you want to take an open book or closed book. That's up to you, because you need to have the information, but there's no problem if you need to look up stuff before you write your answers down. But I would suggest you do in fact write the answers before you look up what the correct answer is. And no cheating, folks. And good luck when you take this test. I really would like folks to take it and satisfy themselves that what they've learned from these workshops is in fact useful. I'd like to know that it's useful. Wrapping up, I've got a list of my favorite authors here. I will read almost anything by Christine Benz, Mike Piper, Wade Fowler, Bob French. They put out a lot. They're very prolific writers. Put out a lot of simple papers that are on topics that are important but nice and easy to understand. At the lower end of this list are folks that dig a little deeper into some of the topics, a little more technical, but again, they're interesting folks. My favorite book is probably A Random Walk Down Wall Street, for anyone starting on the investing process. Charlie Ellis's Winning the Loser's Game helps. James Cloonan was the founder of AAII, and he recently published a book on investing at level 3, which has some useful concepts in it. Anybody interested in the philanthropic aspect of what we've discussed, William McCaskill's put out a very useful book called Doing Good Better, with practical help on picking what parameters are important in making your judgment. I've listed some papers that are let you dig a little deeper into what we've discussed. First two are actually the historical ones. Princeton and a couple of other folks put out a paper in 1986 with a follow-up later on determinants of portfolio performance. That's the paper that basically says that over 90% of the performance variation is controlled by your asset allocation. That's the important parameter that way outstrips the stock picking or market timing in terms of the impact it will have on your portfolio. William Bengen's 4% rule first showed up in October 1994 in his paper on determining withdrawal rates. It's a classic. The rest of these are all useful papers. that dig a little deeper into some of the topics if you want to do that. And I've given you websites here that may be useful to you as well, depending on where your interests are. And of course, we end with the mandatory cartoon. Remember at the beginning, I said that your major life decisions and strategy in determining your philosophy probably don't have nothing to do with pushing dollar signs around on a spreadsheet. That's shown clearly here. I've never yet seen a hearse with a trailer hitch attached to it. So think about that. I want to thank everybody for joining me in this journey. It's been a pleasure. I've enjoyed doing it. I hope you've enjoyed it as well. And I hope you get something useful from our workshops.
This is Holly Stump, Fred's video editor, wanting to thank Fred Smith for the many financial planning cycles that all of us have enjoyed and profited from. Thank you, Fred.